investing feels like a roller coaster. Markets crash, inflation rises, companies fail, and just when you think it's safe, boom, another crisis. But here's the thing, the wealthy don't panic. They understand risk, and more importantly, they manage it strategically. Today, we're diving into the different types of investment risk and how successful investors navigate them. Stick around, because by the end of this video, you'll see risk in a whole new way.
What is investment risk?
Risk is the possibility of losing money. But without risk, there's no reward. The key isn't to avoid risk, it's to control it. And to do that, we need to break risk into categories. Risk 1. Market risk, the big one. Market risk affects everyone. When the economy takes a hit, almost all investments feel the impact. And within market risk, there are different types. Equity risk. Stocks fluctuate daily, sometimes dramatically. If you invest in stocks, this is the risk you face. Interest rate risk. Bonds aren't safe from risk either. When interest rates rise, bond prices drop. That's why rising rates can shake the bond market. Currency risk. If you invest internationally, exchange rates can eat into your profits. A strong dollar might hurt foreign investments, while a weak dollar could boost them.
Commodity risk. Oil, gold, and other commodities can be highly volatile. Geopolitical events, supply chain issues, or even weather can send prices soaring or crashing.
Remember, smart investors don't ignore market risk. They plan for it. Risk 2. Credit risk. The possibility of default. Ever bought a bond? It's basically lending money. But what if the borrower doesn't pay you back? That's credit risk. The possibility that a bond issuer or borrower defaults on payments. Higher risk bonds offer higher returns, but they also carry a greater chance of default. The wealthy understand this and choose bonds wisely. Risk 3. Liquidity risk, the ability to sell. Imagine you need cash fast, but no one wants to buy your investment. That's liquidity risk, the risk of not being able to sell an asset quickly without losing money. Stocks? Usually easy to sell. A rare collectible or real estate? That could take months. The wealthy manage this by keeping a balance. Some investments that are liquid and some that take longer to sell.
Risk 4. Inflation risk. The silent killer.
Inflation eats away at the value of money. If your investments don't keep up, your purchasing power declines. A savings account with low interest? That's a guaranteed loss when inflation is high. That's why successful investors look for assets that outpace inflation, like stocks, real estate, and inflation-protected bonds.
Risk 5. Business risk. When companies struggle. What if the company you invest in starts losing money?
Business risk is the chance that a company faces financial troubles due to bad management, competition, or economic downturns. That's why wealthy investors research companies and diversify over different economic sectors. Risk 6. Political and regulatory risk. When governments step in. Governments can change the game overnight. New tax laws, stricter regulations, trade restrictions. All of these can impact investments. The wealthy stay informed and plan ahead. Risk 7. Reinvestment risk. The hidden trap in bonds. Let's say you invest in a bond that pays 5% interest. When it matures, you want to reinvest. But now, new bonds only offer 3%. That's reinvestment risk, when future returns are lower than before. To manage this, investors use strategies like bond ladders, spreading out investments to balance risks. Risk 8. Concentration risk. The danger of putting all your eggs in one basket. What if 90% of your portfolio is in one stock? If it crashes, so does your wealth. That's concentration risk, being overexposed to a single investment or sector. The wealthy avoid this by diversifying, spreading money across different investments. Risk 9. Behavioral risk, your worst enemy. Sometimes, the biggest risk isn't the market, it's you. Panic selling, FOMO buying, overconfidence. These psychological traps lead to poor decisions. The wealthy control emotions, stick to their strategy, and think long-term. Let's review. Systematic versus unsystematic risk. What can you control? Systematic risk. The risks you can't avoid. Recessions, political turmoil, interest rate changes, anything outside your control. Unsystematic risk. The risks you can control. Asset allocation. Investment selection. Emotional decisions. The key? Diversification. It won't eliminate risks, but diversification can help reduce the impact of negative events.
Risk isn't something to fear, it's something to manage.
The wealthy don't take reckless risks, they take calculated ones. Now you have the knowledge to do the same. If you found this helpful and would like to learn more, hit the link in the description to find my contact information. See you in the next video.